But here's what we want to do is freeze the value of that IRA and never pay tax again by converting it to Roth.
It's all going to get into this issue, and this is what's called self-dealing. So the IRS is looking at, is there some unfair benefit taking place? Welcome, everyone, to the Directed IRA podcast. This is Mat Sorensen, joined by Mark Kohler, attorney, CPA, surfer, extraordinaire, mountain man.
Rockstar. Let me throw that in. Okay.
Yeah. So we are, this is the People's Show today, by the way, guys. This is time to answer your questions about building a retirement account, self-directing, using Roth, all these awesome strategies we love to talk about every day on the Directed IRA podcast. But we're fielding your questions today.
Yeah. This is a great show. It's funny how many people, this is one of the more popular shows because you kind of don't know what you don't know. And it's fun to hear the questions of other people around the country and are like, damn, I never thought to ask that question. So if you find this show helpful, please share it with a friend, someone that you actually care about. Don't send it to your brother-in-law. Send it to someone that you know wants to build wealth. Send it to your kids so you can get them off the dole and you don't have to give them money anymore. Just all the basic people in your life that'll make your life easier. That's where you send this podcast. So hope you have a chance to learn something today. All right. Well, Matt's going to control the line of questioning. I see he's down there looking at his computer, focused, ready to go. You're going to throw out our first. Yeah. Is it a softball or is it a hardball?
I'm going to go with the. This is like, it's not like T-ball, but it's not major league. It's kind of like a coach pitch, maybe.
Okay. All right. Okay. You're going to give me the coach pitch, and then you're going to take the hardballs.
Yeah. I'm going to take the T-ball. I'm going to take the T-ball ones. All right. This one's from Joanne. It says, hi, Matt and Mark. I caught the tail end of a YouTube video where a person was stating taxes on Roth conversions had to be paid quarterly, beginning with the quarter of the initial conversation. And if not paid quarterly, the person would be subject to massive penalties and fees. Is that true? Why couldn't taxes be paid towards the end of the year? Matt, can you clarify this? You're the only voice of authority I can trust to tell me the truth. Thank you guys.
She said Matt? She said Matt?
I'm just reading what's on the page.
Oh, my hell. Yeah. Little did you know, Joanne, I'm going to be the one to answer this today. So
I'm calling in a lifeline, Joanne. Burning my lifeline. Mark Kohler's here.
Yeah, this is your one call. All right. Okay. Now, everybody, let's bring this full circle. One strategy that Matt and I love is living tax-free. Most people don't complain about that. So what we want to do is take all these IRAs we're building and 401ks and slowly convert them to Roth, especially before you go into a bigger investment that you kind of know is going to have a big payout. I kind of call it a Roth freeze. I love Dairy Queen and their, different freezes they have there. But even I think Sonic Burger has a good, like tasty freeze.
Blast. They call it Blast. Sonic Blast. Okay.
Yeah, those are good. But here's what we want to do is freeze the value of that IRA and never pay tax again by converting it to Roth. Then you go do this big investment that might have a 2 or 3x return or who knows what. But the point is we want to convert to Roth. So if some of you are like, why are they asking this question? It's because freaking A, it's awesome. We want to be converting to Roth little by little every year. Now we've taught Roth chunking where you don't want to convert too much and bounce into a much higher tax bracket. You kind of want to like Roth up to the next bracket. And then unless it's a small bracket change, there's 2 big jumps in the brackets that we want to avoid. Anyway, so when someone says, well, I'm going to convert to Roth, let's say it's June and you've got a deal going down and you're like, man, it could have a big payout before year end. The day you convert to Roth is the day you freeze the value of that IRA. So you can't say, oh, I'll make this investment IRA Roth and then convert later this year. It's too late because you have to do a fair market value analysis the day of the conversion. So before you go, pop in this new self-directed investment out of your account, and I know many, many of you have the self-directed IRA account or your 401k, convert to Roth. So if you convert to Roth in June, the question is, when do I pay the tax on that conversion? Can I wait up until April 14th in 2024? Do I have to make a deposit? Do I have to do it before year end? Well, the devil is in the details. Now, I like Joanne's question, can't I do it later in the year? You could. Here's the general rule, and then we'll unpack it. If you don't want estimated tax penalties, and by the way, the penalties are not off the chart. I could give you the exact maybe I'll come back to that in a moment. I'll pull it up. But the estimated tax payments are not that bad. The IRS is just saying we want our money sooner than later, so we're going to penalize you if you don't make a deposit. Now, here's the get out of jail free card. If you make less than 150 grand a year on last year's return, so you look at your 2022 return, and if you made less than 150 grand, you just have to deposit 100% of what you paid in taxes last year, and there's no penalties. I mean, you can make $1 million this year, and there's no estimated tax penalty because you deposited 100% of the taxes you owed last year. The IRS is like, you're good.
Yeah. They're like, as long as we got what you made last year for this year, we're good.
Yeah. Now, I'm not saying that's a good thing because you don't want to have this massive bill coming down the pipe that you're not prepared for. You may want to deposit, but there's no penalty. If you make more than $150,000 a year, the deposit exemption is 110%. So you've got to say, how much did I pay in taxes last year? Oh, I paid 50 grand in taxes. Then, I better deposit 55 grand. And then I'm good. So and then you can, again, not have the requirement to make a deposit. And Joanne, whether you do that deposit now or in July or in December, it doesn't matter. It's not due until April 15th. So you have all that time to get your affairs in order to make that deposit if you want to wait that long. And I'll say, here's the gaming, high-level strategy. If you have the self-discipline to invest that money and put it somewhere, and you can make some money on it up until April 14th, knock yourself out. But some people don't have that self-control, and they use that money in an emergency, or they get into a bad situation, or they get greedy, and then they just think mysteriously this money's going to end up in their account April 14th, and then you're SOL. And I'm not talking statute of limitations. So make sure you set that money aside for the deposit, and deposit at least 100 or 110% for last year. That's the rule.
Okay. All right. Okay. Love it. Thanks, Joanna, for that question. Thanks, Mark, for fielding it. All right. I got Logan's question. I'll take this one. This was about Roth IRA and managing a self-rental. Logan asked, hey, guys, I've heard you talk about needing to be below a certain percentage of ownership from a retirement account in a partnership if you want to manage something like a rental. At least that's been my understanding. I'm going to come back to this because I'm going to disagree with you on some points here. It depends on what you're doing. If I were to invest a Roth IRA into a partnership with someone who is not a family member or other disallowed party, disqualified person, what would the magic number be where I could still manage it myself? Is there a magic number? Okay, Let me go back to the rules here that Logan's asking. Your IRA can buy a rental property. It could own it 100%. You can manage the property in terms of doing paperwork, decision-making, writing a lease, collecting payments, meeting a contractor, telling them what they can do.
Manager of the LLC.
Manager of the LLC, okay? As long as you're doing administrative work, managing the asset, that's not going to be a privileged transaction. So when you say managing the rental, I'm not sure I understand exactly what it is, but if we're talking paperwork, showing, collecting money, paying bills, telling other people what to do in terms of physical labor or rehab, I'm okay with that, even if your IRA owns 100% of the property. But if you're like, this is a rehab, Matt, we're redoing the kitchen, or I'm the contractor and I like to work on the properties, you can't do it. If your IRA owns 50% or more, you can't be the one going in and doing work. So to your second part of the question, is there a magic number? And let's say you were going to do the rehab type project, the fix and flip, or rehab for a buy and hold, whatever it may be. And you need to go work on the property, not just paperwork, not just collecting money, paying bills. You're going to put in physical labor. You got to be below 50%, 49% or below. And I'd like you to be, frankly, below a third, maybe even 10% to be really safe, because there's some gray areas there. It's a hard and fast rule. You can't own 50% or more with your IRA and work on it. Below that becomes these 49 shades of gray. It was the prequel to 50 Shades of Gray.
That's right. That's right. And I just want to, some of you may go, well, isn't there a magic number? The IRS, in a case, there's no case law that tells us what that magic number is. And so what's his name to ask the question?
Logan.
Logan, do you want to be that test case? So you push it and you go 49%, you're probably going to be that test case, and they're going to say from now on it's 30% or 35 or 30 or 20. So we're just trying to be cautious, saying, try to stick under 30% or less or even more, because you don't want to be that test case. Someday the IRS is going to tell us that number, but they haven't yet. Now, Matt, can I add to the question too further?
Yeah.
He started the question out with the word self-rental. So I think another variation on this is, can I rent the property to my other business? Where does my IRA need to be in ownership for me with a third party partner? So my IRA partners with friend. How much does the IRA can own before I can rent the building that the LLC owns? What do you think? Same rule, 20, 30%?
Same thing. It's the same 50% issue, and then we also got what varying shades of gray do you want to be in? So it's the same issue. And that's for anything. Like, you want to get compensated from a deal your IRA is invested into. You want to put more money into a deal personally that your IRA is invested into. You're going to lease the property that your IRA is an investor into. It's all going to get into this issue, and this is what's called self-dealing. So the IRS is looking at, is there some unfair benefit taking place? And so that's what they get at, self-dealing. And people win and lose these cases. Sometimes people are at 30% in a deal with their IRA, and their company's working on the other side of it as, doing business with it. They win. Sometimes people lose. So, and there's plenty of cases in my book on the Self Directed IRA Handbook on people winning and losing in this area. So this is where you want to get a tax consult with a lawyer, because when you're in the shades of gray, the details really matter, and we can help say, make sure you do it this way. Here's some safeguards, or also just give you the advice so you know what you're getting into. And some of our clients are like, I'm okay with a little risk on that. And some of our clients are like, nah, that's not my style. If there's this much risk, I'm out. And we can get into that in a consult. Attorney-client privileged, of course.
Love it. And let me throw this out. Yeah, boy, Matt, you said a lot, and I love it. I want to unpack a little of that. Is when Matt said some people lose, some people win at that 30%. We're not saying they lost because it was 30%.
Yeah.
Usually they're doing other things that get them in trouble. And it's kind of a package of issues. And if any of you want to feel safe doing this, that's why you do a consult with one of our tax lawyers, and we build the LLC for you. We give you a comfort letter, and if we're wrong, then that's what our malpractice insurance is for. Now, we also may warn you and go, yeah, it's gray. Do you want to go or not? And then it's on you. So we really try to have that collaborative conversation that helps you do what you want to do. Yeah. There's other law firms that won't even touch this. There's IRA custodians that won't touch this. In fact, they go running to the hills for any type of LLC. You don't want to be there. There's a great place in the middle, and that's what we're trying to do, is make sure that you're safe, you're cautious, and you're off to the races.
Yeah. Awesome.
I like the attorney-client privilege. Can I say something about that too?
Yeah.
Okay, let's say you get audited on an issue with your IRA, and all you had was a phone call with your accountant, your CPA, enrolled agent, financial advisor. They can subpoena all the conversations you had with that planner and try to figure out what the hell you were trying to do. And that person that's called to be a witness, I think they're not going to, cover your back. If they say you were trying to game the system, or there was some little detail that was not, in the best light, they're going to find out. But if you have a phone call with a lawyer, a tax lawyer strategizing this, and they call me up and go, what was your client thinking? I'll say, go pound sand. This is attorney-client privilege. Good luck. Read the LLC, and so that's why the tax law helps a lot too, having the lawyer in the mix.
Yeah. Yeah. I mean, you could tell us you killed somebody, and we don't have to disclose that. That's how powerful attorney-client privilege is. Now, if you did that, we're not the law firm for you. But I'm just saying, if you start out one of our calls with, and I killed someone, we're the wrong law firm, but don't worry, we can't tell anyone. All right, this is a great question. Next one in here. This is from Alyssa, I don't know. Forgive me, from Kansas. Great question here. Mark's going to love this question.
Oh.
Mechanics of multiple investors via a Roth LLC. She says, hi, I'm new to the directed IRA approach. Thanks for stumbling into you guys a year ago, and I'm ready to jump in. We are in the process of opening a self-directed IRA with directed IRA. You guys, thanks so much. For each family member, myself, age 49, husband, age 52, daughter 19, son 16. We would like to buy our first rental property together if it makes sense. Now she says, I'm in the process of rolling my traditional IRA into a self-directed IRA. From everything I'm listening to your podcast, I'm just going to rip the Band-Aid off and pay taxes while also keeping an eye on the tax bracket. I'm going to be converting $100,000 to Roth. Number
Man, I
2,
love
she
it.
says, I know you love this one. I'm digging this. This is a great question. Husband 2, just starting his. We're going to put in 6,000 of his. We put in 6,000 of his by January of 2023. Okay, now you can do $6,500, by the way. Or wait, this is for this year, January of 2023. Okay, you can actually do $6,500, by the way. And his husband is 52. He can do $7,500. Come back to that. Daughter, just starting out, and goal is $6K by next summer. Son, just starting out, and goal is $6K by December. We're going to come back to some of these. There's some points there. Here's our questions. I understand it's best to use an LLC within to do the transaction. Will we each need an LLC? I'm pretty confident the answer is yes. Let's just start there. She's got a few questions here. We can unpack the fact. I'll throw it to you, Mark.
Yeah, no, this is a great case study for a lot of you listening.
Yeah.
And love what she's doing. First of all, involving the family, doing a Roth conversion, getting the kids in the mix, buying a rental instead of stock in Wall Street. Freaking A, Alyssa. Hats off. Good job. Now, you say, I understand it's best to use an LLC. It's required. So don't think you're like doing best practices. This ain't happening without an LLC. Number 2, you only need one LLC for the fact pattern you talked about. You would meet with one of our tax lawyers. They design the LLC and then contact Directed IRA to move all the money over. I know he's going to tell you about what numbers to consider. Lots of options there. But when you set up that LLC, the law firm's also going to talk about the pro rata distribution. If you're putting in $100,000 and your husband's putting in $6,000 and the kids are putting in $6,000, that means we're into this thing $118,000. So you're going to do, now we may change those numbers. Matt's going to give you some tips here. We'd like to maybe even see if there's a solo 401k option in your life. There could be a lot of cool things here. But let's just say it's $118,000. That means your husband owns 6 divided by 118. That's his ownership percentage, which might be 5.1% or something like that. And then and the kids might be each 5% and you're 85. So anyway, there's going to be a spreadsheet here that'll determine the ownership percentages, and you're going to form an LLC, and then the attorney will talk with you about debt, what kind of debt you can get and what type of rental you might get, and so many good conversations. But you're going to use an LLC, and the percentages of ownership will be pro rata based on how much each party puts in.
Yeah, love that. Now, one of the things to keep in mind for the future, though, Alyssa, is, and we're going with Alyssa here, by the way. Sorry if we're getting it wrong, but that's what I'm going with. If you're planning to make future contributions to these Roth IRAs for your husband, your kids, just know it's going to be tricky getting that additional money into the LLC down the road. See, when we have disqualified people coming into an LLC like this, you, your spouse, your kids. Once we fund that LLC and set that ownership, when that schedule Mark talked about and those percentages, that's set. If you want to put, and let's say for sake of this, you were 80%. Let's say you were 85, and then son, husband, daughter were 555. Okay.
Yep.
So, and you need 10,000 more bucks. Okay, your IRA's got to put in 8,500. Your Roth. Then they could each put in $500 each. So whatever amount's going in has got to happen on the ownership. So if they're putting in 6, that means you've got to be putting in a lot more. Because I don't even know what that's going to compute to, but that's going to be a lot. You're going to be in the 30,000 plus of how much you're going to have to put in to keep those ownership percentages aligned.
Yeah, but let me throw this out too. Listen, don't get dismayed. Matt's talking about the possibility that you need to put more money in the LLC for some reason. We want you to build this LLC that it has proper reserves. You're buying a rental property that makes sense for $118,000 in this example, and that you're prepared for some some bad weather, good weather. And if things go well, you don't have to put more money into it. There are some exemptions to that rule if the sky's falling. But just know that typically everybody 2 years from now they may go, "Oh my gosh, that was great. Let's do another one." And they build up Roth IRAs, and you do a second LLC. That's usually the best way to go at it, is every couple of years you set up a new family LLC, put in new money, and do it again, and do it again.
Yep.
And 10 years from now, you're freaking rocking.
All right. Another variation of this, and one option here, just throwing out options. You could do an LLC 100% with your Roth IRA, and then the four of you do a second LLC that each of you own 25%, and you each put in $6,500. Why would you do that? Because that LLC every year you're going to be dropping a new $6,500 in because you all own 25%, and you can all put in an equal amount between the four of you, the $6,500. And so that could be another nice way to do it, because then you got your LLC with the bulk of the money that you already have that you could do single member LLC, and the other one could be one that everybody's going to be throwing money in for another 10 years or 20 years or whatever it may be of contributions, plus it's investing, it's growing, and that's the partnership. You could take another option that way. It could be another consideration.
Yeah. And last note, everybody, keep in mind there's some. You kept throwing out the word $6,000. Alyssa, please reconfirm, and you can easily talk with one of the team members at Directed IRA via chat, or even call your own accountant or just do some basic research. I've got my calendar with a lot of this data. Your husband at age 52 can put in $7,500. Your kids can put in $6,500. Also, you might want to add for the two kids a Coverdell IRA to the mix, which is an extra $2,000 each. You might, if you have a side hustle at all, we might want to implement a solo 401k and pop 10 or 20 grand into that. So there's some other ways to raise money to get a bigger LLC if you've got the wherewithal to do it. And also make sure you know that you've got to get all these contributions in at the day you form the LLC. You can't say, "Oh, son's going to do 6,500 later in the year." Well, this LLC ain't starting. The train's not leaving the station, so everybody's money's on that train. So you may want to, you could loan your son the money so that he can contribute to his IRA, and then he can pay you back. But at least the IRA is in the LLC and off to the races, and then he's going to pay you back as he earns his money. So think of your start date and what your plans are there too.
Love that. Okay, she asked another question. How does selling the real estate down the road work? Who decides when we get to sell? What if we've never sell and pass it on to our kids? How do they manage if they have different percentage of ownership?
Boy,
Right now,
how the secret to life success or two? Any other questions? Holy crap. It is a good question.
Well, it's such a good fact pattern, it's a good one. So whenever you're in a partnership scenario, you're basically going to have terms in the operating agreement of the LLC, which we drafted our law firm, KKOS Lawyers. And in that operating agreement, it's going to say how you decide to sell. Now, a lot of operating agreements are going to say majority rules. Sometimes it's going to say for big decisions like selling a property, buying a property, incurring debt, or things like that, it might take unanimous approval. Now, in our operating agreements, it's generally going to say majority rules. Frankly, since, Alyssa, you're going to own the majority of this, if we stick to scenario one, you're going to be in the power, you're in the driver's seat about whether you're going to sell or not. Now, if you want to pass it on to your kids, the only way you're going to pass on something from your retirement account to your kids is actually you passing on and getting buried 6 feet under. All right, you're going to have to die because you can't just transfer it to them during your lifetime. That's prohibited. But they can get an inherited Roth IRA from you. So if you do keep this on and build a legacy, and you keep building assets and growing this, and 50 years down the road you pass away, and they could do an inherited Roth IRA and inherit the account from you and or your husband.
Yeah, I'd say it even a different way too, Alyssa. You said, what if we want to leave this real estate for our kids? Well, guess what? You already are. Because when you set up your Roth account, you're going to set the beneficiary as your spouse, and then I would like to see your revocable living trust as the backup, or the kids. We always like the trust first, but let's just say right now it's already built to go to the kids. That's how it's designed. So if you die, you and your husband die, it's going to end up in the kids anyway. If you decide to sell it before then you just distribute the money pro rata to everybody. And you guys can keep building this LLC for multiple, not generations, say 2 or 3 decades, couple 20 years, whatever, or you can sell it 4 years from now and then just take the money, close down the LLC, push the money back to the IRAs and start fresh. So lots of options there.
All right. Awesome. That was a great question. Let's move over to Chetan. I'm sorry, guys, me struggling on the names here. I feel like I'm like in a skit here. Aaron, I can't get the names right. All right. Okay, question from Chetan is 401k loan, needing an LLC or can I use my S Corp? Says, hey guys, listen to your podcast a little while ago. You mentioned an LLC for business startup, but you didn't mention S Corp. Can I borrow from my 401k to support expenditures in my S Corp and get a deduction for the loan payback? So let's say you've got, in this scenario, I'm going to assume some facts here. You have an S corporation, that's your operating business, and you have a solo 401k or 401k plan that S corp has. Or maybe this is a side hustle S corp and a day job 401k, doesn't matter. Can you borrow from your 401k? Yes. You can borrow half the balance of your 401k not to exceed 50 grand. So if you got a 401k with 200 grand, you can take half the balance not to exceed 50. You can take 50. If you got an 80,000 401k, half the balance not to exceed 50, half the balance is 40, okay? So you can take that amount as a loan to yourself. Now you could put it into your S corporation and then start paying interest on that, because when you do this loan, this is called a participant loan, you have to pay it back over 5 years or it's a distribution. But there's interest on this, which is prime plus 2%, which that might be 7% now total there. That interest you're having to pay back, but it's going to your 401k and building your 401k, not to a bank or credit card company. So it's pretty nice.
Yeah.
And you get to expense it because it's in your business. So that interest payment is building back your 401k, and it's an expense in your business as a business interest expense. So totally possible.
Yeah. Now, if you take that loan and use it for a personal expenditure, which we would never recommend, we want to build that 401k to grow and build wealth, not to pay off debt. If you need to do a debt snowball and kind of get your life in financial order, don't handicap your 401k doing that. Or bootstrap your 401k. Let's use some debt snowball strategies and really get you geeked out on Dave Ramsey or Jaron Bergeson, one of our attorneys in our office. We want to get you out of debt without using your 401k to do that. But if your business needs a little shot in the arm and you have a good business model and a good plan, and you want to borrow from the 401k up to 50 grand to do that, that's cool. Just be cautious. We can't forget it's a loan. Now, another perspective I want to add, because I had to deal with this yesterday, Matt, is this infinite banking life insurance strategy. And a lot of these life insurance agents poo-poo retirement accounts. And they'll even say liquidate your retirement account to buy life insurance. It's totally reckless, in my opinion. Now, I want to say this. Does life insurance, whole life, universal life, index universal life, and the whole strategy of building some cash value in life insurance, does it work? Absolutely. As long as you don't mech it out, and your life insurance agents know, I know this, I know it. And as long as you don't mech it out and you build it properly and you let it marinate and you give it 10 years, I think life insurance technically is phenomenal. You can borrow it against it tax-free. But if you don't keep up on it, it falls apart. And so a lot of people get into life insurance and it implodes on them because they really shouldn't have bought it in the first place. Now, why do I bring this up? Because a lot of people think, oh, you can put this in your life insurance and borrow it right away, and you got this infinite banking, blah, blah, blah. And just keep in mind, these life insurance agents are making great commissions along the way to sell this. Mm-hmm. The 401k has a place too. It does. And when you can borrow immediately from your 401k, you could literally make a contribution tomorrow to your 401k and borrow half of it right back out and pay interest back to yourself. But of course, the life insurance agent will say that. And when you make a one-time premium into a life insurance policy, you borrowing it out on the next day handicaps the whole process that they were selling in the first place. They don't tell you the infinite banking kicks in 10 years from now, not tomorrow, because there's policy premiums and all these sorts of things. You got to be careful there. Now, insurance agents out there, I know I dumbed that down. I know I kept it simple. I know there's a lot of different types of life insurance policies. And I own life insurance. I think it's great. But for the right person, at the right time, with the right purpose. And don't you dare tell me that it's the get-all, end-all. It should be a part of an overall plan, everybody. So I want to be buying rentals. I want to be funding my Roth. I want to be funding my 401k. And I might be using life insurance too. That's good. But anybody that shows up, even Matt and I, and says, don't do anything else, do it all in your Roth. Have you ever heard us say that? No. We're well-balanced guys too. We want to take a balanced approach. Anybody that's saying it's all one way or not any other way, that should set up red flags right there. So, I know, Matt, you didn't know where I was going, but I brought it home.
I love that. That was such a great point. And I get that question too. That is this is such a common question and conundrum, I would say, of people, because they get stuck on that and one's better than the other. And no, you can have both. They're both different strategies and they can both apply to different people. I think the Roth, frankly, is more universal in the sense that it can apply to more people and they can utilize it and benefit from it, where the IUL is a little different, in my opinion. But anyways, this is not we're going to do a podcast alone on Roth IRAs versus IULs and pros and cons and what you should be thinking about them, because some people just say one's better than the other. And we want to debate that and dig into the details. But stay tuned for that.
Yep.
All right, we got Kyle from Texas with a question. This little fast one here we can hit says, howdy. Howdy from Texas. Okay.
I love it.
I got a standard IRA account at Directed IRA. I think when it says standard, it means traditional. It said, Mat Sorensen spoke about fees on one of the recent podcasts. I want to make sure I get it right. Am I better to pay the account fees using my personal credit card or with uninvested funds from the account? I want to avoid doing anything that would be considered a distribution, as I am a long way away from qualifying for any distributions. Thanks for your help. Okay, Kyle, great question. My general thinking is pay with a credit card. Pay with personal funds.
Start with, you can do either one. You can do either one.
Yes, you can do either one. So you can pay with your credit card or personal funds, or you could have the fees deducted from the balance of your account.
And it's not a distribution.
And it's not a distribution. We're just, this is whether you're a Directed IRA at other companies. Now, a lot of our clients choose to pay by a credit card, and they just have it on their account. We deduct it every year. You have fees coming up. The reason why is they want more money to stay invested, to be working and growing for them, particularly Roth IRA clients. If you think about your Roth IRA, we can only get so much in. To get traditional over Roth, we got to convert. Why would I then let that money go out in fees? I'd rather pay the fees from my personal funds. And when I pull the money out of a Roth, it's totally tax-free. On the other hand, when you think of your traditional, if I pull the money out of my traditional, when I get there at retirement, I got to pay tax on it. So sometimes clients will say, in my traditional, just deduct my fees from there. Particularly clients that are later on in their years, 50s, 60s, they're starting to pull on it in their 70s. Those ones, it's like, just deduct the fees from my account because I'm pulling money out anyways. And it's not taxable to deduct my fees. But I even say, Kyle, for traditional accounts, which sounds like your situation, if you're 30 or 40, I don't want to take money off the table because we can only get so much in a retirement account every year. I'd rather you pay with a credit card and incur that expense there than taking from the amount of money that can grow and invest for the long haul. But if you're later on, I get it. You're already taking distributions. You're in retirement. Maybe you just have the fees deducted from your account. I don't know. What's your thought, Mark? Do you concur?
No, agree. Matt, well said. Amen.
Right.
I had nothing to add there. Perfectly said.
All right. Okay.
Let's see. Let me ask you, Matt, and let me ask you,
Yes.
and we've said, though, are those fees tax deductible? And regrettably, they're not. They used to be as an itemized expense because they were an investment expense. So you'd like to think they were a write-off. Now, if it's a solo 401k, those fees are going to be a deduction in your S-Corp. But if it's just an individual retirement account or Roth, then those fees that you do pay with your credit card aren't a write-off. And they're not a write-off inside the retirement account either. I just want to answer that because some people say, well, can I write that off? And you can't.
Yeah. Good question. But Jerry, everything's a write-off. All the companies are doing it.
You don't know what a write-off is.
All the companies are doing it. All right. Okay, let's hit the last question here. This is from Sam. Sam's in Utah. Question on a 401k investing in a partnership. It says, me and two other individuals are creating a SaaS product, software as a service, in our area of expertise. All three of us will be actively managing the business. Can
I
I
see where
use
this
my
is going.
solo 401k to invest in the business? My 401k would be a 1/3 owner. Would I be able to take a salary in the business and have all the dividend distributions flow into my 401k? Can I invest half of my 1/3 using 401k and half using personal funds and still take a salary?
Well, this
Ooh,
goes back to our first question of the day.
it really does. It is all coming back full circle here. And I
Yeah.
know everyone hates to hear this answer from a lawyer, but it depends, Sam. Now, let me say the good news is you've got some daylight on this. You have options. Sam,
Yeah.
if you told me it's me and one other partner and we're 50-50 doing this, I would say not a chance. You don't have any, it's not possible.
Yeah.
But because it's 1/3 and you got 3 partners and your total ownership between your solo K or 401k and yourself, no matter how you do it, is going to be 1/3 or less, I think you've got some options here where you could work and be involved in the business. Take a reasonable salary, you know, and I think you got some options. Now, there is some prohibited transaction risk here because depending on the IRS agent or tax court judge, they could look at this and say, was this compensation you were taking fair? Was that investment amount you put in fair? But because there's 3 people here, and I presume the other 3 partners are going to have to put in the same amount of money to get this business off the ground too. Let's assume you're going to take a reasonable salary. It's not going to be too high, not too low. It's going to be right where it should. I think you're in a good spot here where you could do the structure, but there's still a little prohibited transaction risk because you are a significant owner of the third, even though you're below 50%. So
Now,
I'm
let
going to
me.
say like yellow light, proceed with caution.
Yeah.
It's
Yeah.
not green lighting it. It's,
Yeah. Well, and here, let me give a few caveats to dive a little deeper. We don't. This is the first issue is this. You're not going to take a salary. This is going to be an LLC. So you have to realize that this, and that's how we would structure it anyway, whether your 401k was in it or not. So this is going to be an LLC, and each partner is going to be an S corporation. Let's start there. And I'm hoping you're getting that advice. Now, knowing that you're in Utah and some Utah County lawyers trying to steer you around and charge you $5,000 for an LLC, or you're trying to hack this out on LegalZoom because at the last church meeting, that's what they said to do. Please, Sam, buck up and do it right and get with a tax lawyer at our office and get your partners on a phone call. So first and foremost, this should be an LLC, and each of you as participating partners should be an S corporation. That's in my book. That's 101. And if your accountant and lawyer are not on that page, you better get another freaking opinion. And I mean that. I am absolutely right. I will debate anyone in court on that one. Now, if you add your 401k to the mix, your S corp could be a 12.5% owner, or what would it be? No, you're going to be 33. So it'd be 15, no, it'd be 16.75, whatever. So you're going to take your 33% and divide it in half and go part 401k and part personal. That's cool. But it's not going to be you. It's going to be your S corp. The salary is going to come out of your S corp. Now, this is going to be a little tricky because now you've got to go back to the LLC and go, what are our guaranteed payments for services we're providing? That's how it's going to be handled. So you're going to have an LLC with 3 partners that get paid a guaranteed payment. It's like a salary, but it's not. It goes to your S corporations, and that's for your services. Now, this is where Matt's saying there's caveats because you can't, hit your salary really hard one year and then give the 401k less. Oh, put more in the 401k and give my salary less. You're going to want to play those games. Not going to work.
yeah.
So whatever you are owed for your services better be reciprocal with your partners, and that's going to be a guaranteed payment to the S corps. Then profit is split 33, 33, 33, or 33, 33, 17, 17, or 16.75. So you want to really vet this with the tax lawyers. I know a hurdle is going to be you got to get your 2 partners to work with the same lawyer on this. Well, my brother-in-law is going to do our LLC. Well, then this ain't happening, Sam, because not all lawyers know the rules on IRAs. So you got to tell your partners, I want to do this, and you may even have to say, I'll pay for the damn LLC, because you got to get your partners on board. So there's issues here with the S corps, guaranteed payments, and Matt said it too. You got to have equal contributions. And if you're like, well, I don't have enough money, but my 401k does. Well, that's going to help determine the issues too. So there's a lot to talk about. Make an appointment with any of our tax lawyers, and they can set this whole thing up.
Yeah, love it. All right. Well, awesome questions, everyone. Thank you for submitting those for next month's open forum.
Yeah.
If you're like, guys, I want to know the answer to this question, we'll put it on the website already. Go to directira.com/podcast, hit ask a question, and put it in. We want to answer your questions. I know we skipped some of your questions here. We don't have enough time to get to all of them, but we're going to try and pull these ones out that we think will really help teach other people how to self-direct their retirement account. And we're going to be having another open forum, like I said, next month. Of course, stay tuned to the podcast. Make sure you're signed up for our newsletter because we got so many events coming up. We got our Alt Asset Summit coming up in a week. Next month, Mark's got this Tax and Legal 360 event coming up. That's going to be in Salt Lake City. Anything you want to say on that?
3 days, 46 sessions. And 32 topics, 15 speakers, where real estate and tax and legal professionals and business owners can all network together. There's no selling from stage. It's all real content. Many of the classes are going to be CE approved, and you need to be there. And we're going to have Matt teaching 3 different classes on retirement accounts. It's going to, in so many different strategies. Please check it out. And if you're listening to this and you're an accountant, an enrolled agent, a financial advisor, an attorney, please get over to markjkohler.com and check out my certification program. I have a whole module that certifies you in these strategies so that you can be talking to your clients about this, billing for your time, then collaborating with the law firm and getting an affiliate fee many times to bring the whole package together. We want to help you in your practice. So if you're a professional, get over to my certification program. It's affordable. There's nothing else like it in the country.
Love it. All right, guys. Well, thanks so much. We'll be back next week with another episode of the Directed IRA podcast. Until then, stay calm and self-direct on.